Hello everyone, I am Muhammad Munir, Teaching Assistant at Faculty of Commerce, English Section, Cairo University. Today we are going to discuss Chapter 7, Flexible Budgets, Direct Cost Variances. Learning objectives of the chapter: static budgets and variances, flexible budget variances, management use of variances. Let's start by defining some basic concepts. Variance. Variance is the difference between an actual and an expected or budgeted amount. Management by exception. Management by exception is a practice of focusing attention on areas not operating as expected or budgeted. Static or master budget is based on the output planned at the start of the budget period. Static budget variance, we call it level 0 analysis, is the difference between the actual result and the corresponding static budget amount. Favorable variance has the effect of increasing operating income relative to the budget amount, while unfavorable variance has the effect of decreasing operating income relative to the budget amount. Levels of variances. The level 0 analysis is nothing more than the difference between actual and static budget operating income. Further analysis breaks down the level 0 analysis into smaller components. Level 0 analysis only answers the question, how much were we off? Level 1, 2, and 3 examine the level 0 variance into more detailed levels of analysis. The answers: where and why were we off? Simple example. Here are the actual results in this column, and in this column is a static budget. If units sold were budgeted to be 90 units, and here units sold as an actual result is 100 units. Revenues were budgeted by the amount of 2,700, while actual revenues is 3,500. Variable costs consists of direct materials and direct labor and variable factory overhead. Direct materials were budgeted with the amount of 540, while actual results is 700. Direct labor budgeted with the amount 900, while actual amount is 1000. Variable factory overhead was budgeted by the amount of 540, while actual amount is only 500. So contribution margin equals revenues less all variable costs, including direct materials, direct labor, variable factory overhead, will equals to 1,300 as an actual result, while the contribution margin was budgeted by the amount of 2,700 less direct material 540, direct labor 900, variable factory overhead 540, which equals to 720. Fixed costs 600, so operating income under actual results equals 1,300 less 600 equals to 700, while operating income was budgeted with the amount of 20, resulting from 720 less 700 equals to 20. So now to calculate level 0 analysis or level 0 variance, it is very simple. It is the amount of 680, the difference between operating income under actual results and the operating income under the budgeted amount. So 700 minus 20 will equals to 680, and this is favorable variance, as the actual results in the operating income is more than the static budget amount for operating income, so this variance is favorable variance. Now if we want to know the difference of 680, where this amount comes from, or where this difference comes from the details of the differences between each one or each item from those items: revenues and variable cost, and contribution margin, and also fixed cost. So for more details, we will make level 1 analysis. As level 1 analysis, we'll show the difference for each items separately. Let's see how we calculate level 1 variance. Here, first, difference between units sold, budgeted 90 and actual 100. So unit sold is more than the budgeted amount by 10 units. We expected to sell only 90, but actually we sold 100. So now we have 10 units favorable variance. What about revenues? Revenues, we expected revenues with the amount of 2,700, but we made revenues 3,500. So we also have a favorable variance with the amount of $800. Direct materials were estimated by the amount of 540, but actual results 700. So we pay more for direct materials. And what's the meaning of we pay more? We pay more is not considered a favorable variance. It is unfavorable variance, as the cost increase than the expected amount by the difference between 700 and 540, which equals to 160 unfavorable variance. Direct labor, we estimated cost of direct labor $900, but actually we pay $1,000, so also we have here $100 unfavorable variance. Variable factory overhead, we expected or estimated factory overhead, variable factory overhead with the amount of $540, but actually we paid only $500. So here we have $40 difference, but favorable variance. Contribution margin for actual results is 1,300, but we expected only 720 for contribution margin. So we also here have favorable variance with the amount of $580, the difference between 1,300 and 720. We expected to pay fixed costs with the amount of 700, but we only pay 600, which results in 100 difference or variance, and it is a favorable variance. Finally, operating income was estimated to be only $20, but here we made operating income $700, which is the difference between 720 equals to $680 favorable variance. So level 1 analysis show where the 680 favorable variance comes from. Evaluation. Level 0 analysis tells the user very little other than how much contribution margin was off from budget. We only know that there is a difference with the amount of 680 favorable variance in this case. That's all we know from level 0 analysis or level 0 variance. Level 0 answers the question, how much were we off in total? But level 1 analysis gives the user a little more information. It shows which line items led to the total level 0 variance. Level 1 answers the question, where were we off? Flexible budget. Flexible budget shifts budgeted revenues and costs up and down based on actual operating results or activities. Flexible budget represents a blending of actual activities and budgeted amounts. Flexible budget will allow for preparation of levels 2 and 3 variances. Flexible budget answers the question, why were we off? Flexible budget example. Here we have actual results, and here is a static budget as we saw in the example before. Now we need to make flexible budget. First, as previous example, we have level 0 analysis, which is the difference between operating income under actual results and operating income under static budget, and we call this difference level 0, and the details under actual results and details under static budget, we name it level 1 variance or static budget variance. Now we will construct the flexible budget. Flexible budget is constructed by multiplying budgeted input allowed for actual output multiplied by budget price. After we construct flexible budget, we can compare it with static budget and we can compare it with the actual results. When comparing flexible budget with a static budget, this will result in level 2 variance or part of level 2 variance that we call sales volume variance. As the difference between static budget and flexible budget, static budget consists of budgeted input multiplied by budgeted price, but flexible budget consists of budgeted input allowed for actual output multiplied by budgeted price. Budget price here and here is the same. So what is the difference? The difference in the static budget, we calculate budgeted input for budgeted output. But here is the budgeted input multiplied by actual output. So the difference only here is between actual output and here actual input. So what is the difference between actual output and actual input? This difference is the sales volume variance. But when we compare flexible budget with actual results, this difference we call it flexible budget variance. Difference here, as we see, actual price and here is the budget price. So part of the variance here is from the difference between actual price and budgeted price. But we also have another variance. Here it is the actual input, but here is budgeted input. So we have another variance between the actual and budgeted input. So the flexible budget variance, we have two variances. First one is for the price and we call it price variance, and second one concerning inputs and we call it efficiency variance. And we will talk about efficiency variance and price variance in details under level 3 variance. Here, level 3 variance will explore these figures in details, representing direct material and direct labor variance between actual results and flexible budget. These amounts here under flexible budget variance will be explained later. Now let's solve a problem on this part of the chapter. We will start by solving problem number 720. The given in this problem performance report for month of June 2014. We have actual results and static budget, units measured by pounds 350,000 under actual results and estimated by 335,000. Revenues were estimated by the amount of 1,976,500, while actual revenues is 2,012,500. Variable manufacturing costs were estimated by the amount of 1,038,500, while the actual variable manufacturing costs were 1,137,500. That will result in a contribution margin estimated by the amount of 938,000, while the actual contribution margin is 875,000. The business manager for ice cream products is pleased that more pounds of ice cream were sold than budgeted, as given here units sold is more than units estimated to be sold, and that revenues were up. Unfortunately, variable manufacturing costs went up too, as variable manufacturing costs here is only 1,038,500, while the actual variable manufacturing cost is 1,137,500. The bottom line is that contribution margin declined by the amount of 63,000, which is less than 3% of the budgeted revenues of 1,976,500. Overall, eLearning feels that the business is running fine. Requirements. Number 1. Calculate the static budget variance in units, revenues, variable manufacturing costs, and contribution margin. So, first requirement, we need to construct static budget and actual results and compare them in details. That will result in level 1 variance, static budget variance. Here, the actual results and the static budget. First, number of units sold. Actual units sold is 350,000, while it was estimated by the amount of 335,000. 350,000 minus 335,000 will result in 15,000 static budget variance. But 15,000 favorable or unfavorable? Favorable. Why? Because the actual number of units sold is more than the estimated number of units sold, and this is a favorable variance for the company. Revenues. Actual revenues are 2,012,500, while estimated revenues 1,976,500. The difference is 36,000 and also favorable variance as actual revenues is more than estimated revenues. Variable manufacturing costs. Actual variable manufacturing costs is 1,137,500, while estimated variable manufacturing costs 1,038,500. Here the actual manufacturing costs are more than the estimated manufacturing costs, so the difference will be 99,000 unfavorable variance. Actual contribution margin is 875,000, while estimated contribution margin is 938,000. The difference will be 63,000 unfavorable variance because contribution margin under the actual results is less than the contribution margin estimated under the static budget. So, static budget variance will be equals 63,000 unfavorable, which is the difference between contribution margin under actual results and under static budget. Requirement number 2. Break down each static budget variance into a flexible budget variance and a sales volume variance. To get the results under flexible budget variance and sales volume variance, we need first to construct the flexible budget. how to construct flexible budget. We said that flexible budget, what's the component of the flexible budget, is the actual budgeted input for allowed for actual output. So units would be the actual, or budgeted units is the actual units, because units is the output here in this problem. So actual output is 350,000 units. Revenues would equals to budgeted input multiplied by actual output. So what is the budgeted input for the revenues? Is the selling price, or the budgeted selling price multiplied by the actual output, which is number of units sold, actual units. So we need first to calculate budgeted selling price. Budgeted selling price is calculated by dividing the revenues figure here under static budget by the number of units estimated to be sold, as all of these figures are estimated or budgeted figures. So 1,976,500 divided by 335,000 will equals to 5.9. So flexible budget revenues will equals to 5.9, which is the estimated selling price, multiplied by 350,000, which is the actual number of units, which will equals to 2,065,000. Then we need to calculate variable manufacturing costs under flexible budget by the same method. First, we need to calculate variable cost per unit. So budgeted variable cost per unit will equals to 1,038,500 divided by 335,000 unit, which will equals to $3.1. So to calculate variable manufacturing costs under flexible budget, we multiply 3.1 multiplied by 350,000, which will equals to 1,085,000. Then contribution margin will be calculated as revenues plus variable manufacturing costs, which will equals to 980,000. Now we constructed the flexible budget. What was the requirement? The requirement was to calculate sales volume variance and flexible budget variance. Now, after constructing flexible budget, we can calculate first flexible budget variance, which is the difference between flexible budget and actual results. First, number of units sold. Here is 350,000 units. So no difference between the actual and flexible budget in the figure of units. What about revenues? Revenues here is 2,012,500, while under flexible budget is 2,065,000. So the actual results, so revenues under actual results is less than revenues under flexible budget with an amount of 52,500, and of course it is unfavorable as the revenues here is less than the revenues under flexible budget. What about variable manufacturing costs? Actual results for variable manufacturing costs is 1,137,500, while flexible budget is 1,085,000. Difference between variable manufacturing costs is 52,500, unfavorable, as variable manufacturing costs under actual results are more than variable manufacturing costs under flexible budget. Contribution margin. Actual contribution margin is 875,000, while contribution margin under flexible budget is 980,000, with a difference of 105,000, unfavorable, as actual contribution margin is less than contribution margin under flexible budget. So the flexible budget variance, the difference between contribution margin under actual results and contribution margin under flexible budget, which will equals to 105,000, unfavorable flexible budget variance. Now let's calculate the sales volume variance. First, number of units sold under flexible budget is 350,000 units, while it was estimated under static budget with the amount of 335,000, and this result in a difference 15,000 units favorable variance, as number of units sold under flexible budget is more than number of units sold under static budget. Revenues under flexible budget 2,065,000, while revenues under static budget is only 1,976,500. Difference 88,500 favorable variance, as revenues under flexible budget is more than revenues under static budget. Variable manufacturing costs under flexible budget is 1,085,000, while variable manufacturing costs under static budget is 1,038,500, with the difference 46,500 unfavorable variance, as variable manufacturing costs under flexible budget is more than variable manufacturing costs under static budget. Contribution margin under flexible budget is 980,000, while contribution margin under static budget is only 938,000, with the difference 42,000 favorable variance, as the contribution margin under flexible budget is more than the contribution margin under static budget, and this results in difference of sales volume variance with the amount of 42,000 favorable variance. If we add sales volume variance and flexible budget variance, this will result in the static budget variance. Here, negative 105,000 plus 42,000 will result in negative 63,000 or 63,000 unfavorable variance. Requirement number 3. Calculate the selling price variance. The selling price variance caused solely by the difference in actual and budgeted selling price from the flexible budget variance in revenues, which equals to 52,500. Level 3 variances. All product costs can have level 3 variances. Both direct materials and direct labor have both price and efficiency variances, and their formula are the same. Price variance formula: price variance equal actual price of input minus budgeted price of input multiplied by actual quantity of input. While efficiency variance formula: efficiency variance equal actual quantity of input used minus budgeted quantity of input allowed for actual output multiplied by budgeted price of input. Summary of the chapter: we have 4 level variances. 0 level variance is only the difference between operating income under actual results and static budget. Level 1, we call it static budget variance, is the difference between the detailed figures under actual results and static budget. Level 2 variance is calculated by first constructing flexible budget, then comparing flexible budget and actual results, which will result in the flexible budget variance, then comparing flexible budget and static budget, that will result in sales volume variance. Level 3 variance is a price variance or efficiency variance, calculated by the formulas we discussed before, or calculated by another method by constructing actual input multiplied by budget price, and while comparing the amounts under this column with the flexible budget, this will result in efficiency variance, while comparing amounts under this column with actual results will result in the price variance. And we will see how we calculate price variance and efficiency variance by this method in solving the next problem. Solving problem 734. Here in this problem, the standard cost of direct materials and direct manufacturing labor is $223 per board. So this is the cost of 1 unit. This includes 40 pounds of direct materials at the budgeted price of $2 per pound. So each unit consumes 40 pounds of direct materials, and the budgeted price of these materials is $2 per pound. And also each unit consumes 10 hours of direct manufacturing labor at the budgeted rate of $14.3 per hour of direct manufacturing labor hours. Following our additional data for the month of July: units completed 5,500 units, direct material purchases 160,000 pounds, cost of direct material purchases $432,000, Actual direct manufacturing labor hours 41,000 hours. Actual direct labor cost 594,500. Direct materials efficiency variance 1,700 favorable variance. There were no beginning inventories. Number 1. Compute direct manufacturing labor variances for July. So, number 1, we need to calculate the price variance and efficiency variance for the direct manufacturing labor. We can use either the two formulas we studied before or constructing a new column between the flexible budget and the actual results, and then calculate the price variance and efficiency variance. Here, this is the column for actual results, and here is a flexible budget, and here is the new column which is calculated by the actual input multiplied by budgeted price. First, the actual results. Direct manufacturing labor costs were given by the amount of 594,500. Here is the first number. Then actual input quantity multiplied by budgeted price. What is the actual input quantity of direct manufacturing labor? Actual input quantity is the actual direct manufacturing labor hours with the amount of 41,000 hours with budgeted price rate 14.3 per hour. So 41,000 hours multiplied by 14.3, which equals to 586,300 is the actual input multiplied by budgeted price. Then we need to calculate flexible budget calculated by budgeted input quantity allowed for actual output multiplied by budget price. First, budgeted input quantity is 10 hours per unit. Allowed for actual output is 5,500 units multiplied by budgeted price, which equals to $14.3 per hour. So the result is 786,500. Difference between actual results and this column, we call it price variance. So 594,500 minus 586,300 will result in 8,200 unfavorable variance, as the costs under actual results is more than the estimated costs under this column, while here difference between flexible budget and this column will result in 200,200 favorable variance, as actual input quantity multiplied by budgeted price is less than the flexible budget amount for direct manufacturing labor, and this is the efficiency variance, 200,200 favorable variance. Requirement number 2, compute the actual pounds of direct materials used in production in July. The favorable direct materials efficiency variance is given by the amount of $1,700, indicates that fewer pounds of direct materials were actually used than the budgeted quantity allowed for actual output. So 1,700 efficiency variance divided by $2 per pound budgeted price of material will equals to 850 pounds. So the actual direct materials used is less than the budgeted amount by 850 pounds. So what is the budgeted pounds of material allowed for the output achieved? Calculated by 5,500 multiplied by 40, which equals to 220,000 pounds. So the actual pounds of direct materials used is 220,000 minus 850, which equals to 219,150 pounds. Requirement number 3. Calculate the actual price per pound of direct materials purchased. Actual price per pound. Here in the given we have cost of direct materials purchases and direct material purchase amount of 160,000. So actual price per pound of direct materials purchased will equals to 432,000 divided by 160,000 pounds. Here 432,000 divided by 160,000, which will equals to $2.7 per pound. Requirement number 4. Calculate direct materials price variance. Actual result 432,000 is the actual price paid for direct materials. We need to compare it with the actual input multiplied by budgeted price, calculated by 160,000 pound multiplied by budgeted price, which is $2 per pound. So 160,000 pound multiplied by $2 per pound will equals to 320,000. Difference between 432,000 and 320,000 will result in 112,000 unfavorable price variance. And by that we reach the end of our section today and the end of the chapter.